Good morning, everyone. Thanks for joining the webinar. So, what's next after precious metals? So, let me first set the context. So, when we talk about precious metals, so gold and silver are the most important components of them, right? So first, before going deeper into this, I just want to make this somewhat interactive with some few quiz questions that you need to keep in your mind. So when we go through the session, you'll be able to get the answer for that. So I'll just display the question. You can just type them, your answers in the chat box. So first is how much return should you invest, should an investor should expect from gold? You can take this in kind of 10 to 15 years horizon. You can type your answer in the comment box, by the way. Okay, I got from Tarun 5, and Indra gave 10. So you can just not think in a kind of a shorter time period. You can just think 10 to 15 years in that frame. So 10 again. So yes, so I'll just give the answer in the upcoming slide. So I can move to the second quiz. You can answer this also right now. So how much can you lose in a single year? So investing in gold, how much you can in a kind of a calendar year, how much you can lose as a whole? You can just give this also. Is it like in a year I'll lose minus 5% or minus 10%, minus 15, minus 20, minus 10. So I'm getting all the choose as answers right now. So great. So I'll move to the next question also. Yeah, I think someone is minus 20 from John, minus 5, same way right now. So, okay, fine. So it has fallen right now. So now you just think, so how long will a gold take to recover when you invest at the peak? So just think in your mind, like you are invested, so you are seeing that gold has performed really well. Right now, you are investing at that point of time. So suddenly you found that it has started to fall, and what you think the time it will take to come to the same price what you are invested. Okay, 6 years from Ari, six. So you guys are just like thinking that literally 6 years you need to wait without any returns to get to the same level where you invested gold. Okay, 3 years from John. Okay, right now I'll just go through this by the way. So the first big question is how much return can a gold actually deliver? So over the long run. So as I stated, from 15 to 20 years. Because see, recently we have seen an impressive rally and a strong short-term performance. But long-term investing is very different from the short-term momentum what you're seeing. So historically, gold's long-term CAGR tends to be around only from 9 to 10% range. So the thing what you're seeing in this slide, it's absolute. You just calculate in the CAGR basis in long term, it will be only around 9 to 10%. So not that explosive returns, right? So people often expect after the rally phase, it's kind of very important to understand that gold behaves very differently from equities or a kind of a diversified portfolio. It's very important, I want to say. So it moves in a long cycle. So often with kind of this long periods of stagnation. In fact, on a calendar year basis, if you see, gold can fall as much as 20%, as you can see that in the slide. So even more in certain years also. So which suppresses many investors who assume that gold is always a safe haven. So imagine an investor who enters gold purely based on last year's top performance. So you can just think that you can see from 2010, 2011, oh, gold is doing really good last 2 years. We can invest right now. So history shows that can be very painful because gold is not a top performing asset every year. So see, if someone invested near the earlier peak around 2012, it took roughly 6 years. Think 6 years just to recover, to come back to the same price level where you invested. So that's a long drawdown, right? And the recovery period for any investors to stand emotionally and financially is kind of a so tough, I would say. So this tells us that while gold is a useful asset class, it's not a timing friendly asset class also. Same, the principles applies for silver also. So if you think about silver, the drawdown will be like just a second. So if you see about silver, the drawdown will be up to minus 55%. Just think 50% of wealth will go within a time in a year. And if you think about that recovery period for silver, it's even much longer. And even the higher volatility also stands for silver, by the way. So the drawdowns also tends to be deeper and recovery period also longer. So historically, this stretching close to, if you see it's taking around 1 decade, like 9 years to come back to the level where you invested. So which means silver can also test investors' patience, right? Even more than that of gold. So the key learning what is that? So this connects directly to today's theme, that is precious metals are important, but they cannot be treated as a standalone wealth creators or kind of a chased after rallies. They need to be a part of a broader, disciplined multi-asset framework. So, which is exactly where the structured multi-asset PMS approach like Spear becomes more relevant for you. As we move ahead in this particular section, this keep these quiz questions in your mind because the answers will naturally emerge as a kind of connectors between the precious metal with asset allocation and what's next after that, right? So now let's move from stories and past cycles to some kind of hard data on precious metals, because this slide gives us a kind of a more quantitative snapshots of how gold and silver actually behave inside a portfolio. So first look at the correlation matrix in the left top, right? So what this tells us is that how different asset classes move related to each other. So you will notice that gold and silver are positively correlated with each other. So roughly in the kind of mid to high range, which means that most of the time when they tend to move in the same direction, so if the investor thinks holding both gold and silver automatically gives strong diversification, that's not fully correct. They are like related assets, often react to similar macro triggers like inflation expectation, currency moves, and the global sentiments. But when you compare precious metals with equities or other macro assets, correlation are much lower, sometimes even negative. And that is where the diversification benefits actually comes in, not within the metal alone. See, between the metals and other asset classes, let's look at the performance disclosure, that dislocation, that chart also there. So from that, if you see, you can clearly see that silver ETF, means silver has delivered much sharper upside than gold in strong cycles. But that the higher return comes with higher cost also, which is like a high volatility. So that's exactly what the volatility profile below highlights. So silver volatility is roughly about 2 times that of gold. So meaning bigger rallies, but also deeper corrections. As I stated, around 50% you can lose in a year. So silver can accelerate returns in the right phase, but it can also test investors' patience much more severely during the drawdowns. Then look at the forecast recap style summary also. The short term, there can be a dips, medium term consolidation, and then the trend resumptions also. So see, this pattern itself teaches us something important. Precious metals don't move in straight lines. They move in phases, I want to say. So there will be bursts, there will be pauses, and there will be resets. So first investor, the key takeaway from this entire slide is that precious metals are useful, but cyclical, volatile, and internal kind of more internally correlated, which means that they are more powerful ingredients, but not the kind of a complete portfolio by themselves. And they are naturally brings us to the next step in the kind of conversation. If metals are the only part of your puzzle, what should kind of see? It can sit along, it can be sitting along with them. But how do we structure that exposure intelligently through a kind of a disciplined multi-asset approach, right? That's very important. So yeah, just sorry, just in this slide is very important because it's one of the biggest myth, as I stated earlier also, that it's kind of more negatively correlated with other asset class, but you want to know this case also. So investors have a myth that gold that always move opposite to equity market, right? But many people believe that whenever market fall, gold will automatically rise. But historic kind of history, what it shows that it's not consistently true. Let's look at this different crisis period. So the dot-com crash, the global crisis, the COVID shock, and the recent sharp market event. In this, some of these phases, yes, gold did act as a hedge and moved up while equities corrected. But see, especially after the initial panic phase. But if you observe very carefully, during the initial stage of such a sharp market stress, both equities and gold have often fallen together. Why does this happen? See, because in sudden crisis, investors first sell what they can and not what they want, by the way. So they raise liquidity, so reduce their leverage, and even the safe haven assets like gold can see a short-term selling pressure. So only in this next phase, when the fear stabilizes and the policy responses begin, gold often start behaving like a defensive asset. Right. So correlation is not fixed. It is phase dependent, like as I stated in my earlier slide. Sometimes gold is negatively correlated, sometimes positively correlated, and sometimes it simply moves independently. So the practical takeaway for investors is this: gold is a useful diversifier, but it is not a perfect edge at every moment. The thing what I state night now, it also applicable to silver also. So silver also is like not that much easy to predict, by the way. So you cannot rely on any one single asset class for protection across all the market environment. That is exactly why I'm again stressing multi-asset approach. Yeah. So that's why I'm just stressing this multi-asset approach, by the way. So where gold is one component among several and tends to be more reliable than depending on kind of a gold alone for a downside protection. So now that we have discussed the precious metals, their behavior, and why no single asset can be relied on all time. So this brings us to the core investment dilemma, that is timing, allocation, and placement, right? So even in this chart, what you are seeing right now, um, see uh, the movement of silver. The silver is kind of more tremendous, like it has moved up more than 200%. So it kind of a more momentum chasing right now. Because right now, rather than what I want to say is like earlier, gold and silver is seen as a kind of a investor's asset class. But right now, due to this kind of more concentration given to gold and silvers, more kind of intraday trades and more speculation has taken place. That you can see clearly in this chart, by the way. And so this is the reason why the margin calls for entering to the trade also been increased so that the speculative moves can be stopped, by the way. That's another reason. So again, here you can see the performance of different asset classes. As you know that silver has performed really well. You can see the performance, same way gold also performed really well. Yes, Indian markets and the MSCI index in the international markets are keep on, you know, not in par with that what gold and silver has performed, by the way. So now we can move to that important thing. So Spear is designed to solve the main issues. So like the thing like so is it the good time to invest, or how much should I invest right now, or where should I invest right now? So instead of trying to predict one winning asset class, the multi-asset approach accepts the simple truth. There is always an opportunity somewhere. So, but not always in the same place. So rather than all in or all out decision, capital is deployed throughout the targeted addition across asset classes based on the valuation and opportunity, by the way. So this is very important from a traditional mutual fund structure that is restricted by a mandate or a style box. So Sphere as flexible, and it's like more lateral between equity, debt, precious metals, and global exposure, depending on where the risk reward is more favorable, by the way. So the third pillar here is kind of expertise, I want to say. So not just what the invest is in about. It's all about shift between the asset classes without doing disruptive kind of a full rebalance every time. And see, this focuses on kind of identifying the portfolio gaps, introducing new ideas, and adjusting weights in kind of more intelligently rather than more mechanically. So as we move forward from here, think of Spear not as a product, but as a framework, by the way, a disciplined multi-asset engine that aims to remove the timing stress across the period, improve your asset allocation decision, and base capital where probabilities are stronger. So in next few slides, I'll break that down right now. Now let me walk you through our core investment philosophy. So behind Spear, see, because this is kind of where the framework becomes very clear and more structured. So the first pillar is, as I stated earlier, asset allocation. Instead of depending on a kind of a single asset class like equity or gold, what we had talked earlier, to do all the work for you, Spear follows a kind of a strategic distribution across multiple asset classes. So the risk and reward are balanced, right? And the different asset perform in different phases of the cycle, and proper allocation helps you smooth the journey rather than chasing the best performer of the year, where you saw in the starting slide, the quill timing. And the second pillar is the reducing the volatility. Market will always fluctuate. That is more unavoidable. But portfolio volatility can be managed, by the way. So by spreading investment across relative uncorrelated asset classes like what we stated earlier. So the overall portfolio movement becomes more stable compared to a single asset approach. So this helps investors to stay invested and avoid emotional decisions during sharp moves. Then the third pillar is providing a wider range of opportunities, by the way. So traditional portfolios often limited to domestic equities and maybe some debt. but opportunities today are more global and cross asset, by the way. So Spear beyond this traditional stock picking, so the opportunity sets become much broader and more flexible. The fourth pillar is more retaining compounding power. That is, true wealth is not created by one big winning year. It is created by staying invested across cycles and allowing compounding to work over the period of time. So the structure is built to keep capital productive invested rather than moving in and out based on the short-term noise. And this leads to the next kind of natural question: how exactly do we do this kind of allocation? And answer lies is studying the market cycles, asset allocation, and following a disciplined contrarian style also, which means increasing exposure where valuation probabilities are more favorable, and not where the recent terms look exciting. That's the engine that drives allocation addition inside the sphere, by the way. So this slide captures the core style behind Spear's decision making, a combination of contra investing and value investing. As contra investing simply means we are willing to go against the market, popular market trends when data and valuation support us, by the way. Instead of chasing what everyone is buying, we actively look at areas that are currently out of favor, because that is often where pricing becomes attractive due to over kind of reaction and pessimism, by the way. So many times, market overshoot both on the upside and the downside, and the contra investing kind of tries to capture those mispriced phases with the discipline and not emotion. It's very important, right? Along with that, we follow the value investing principle, which means buying asset that have a strong fundamental, but or kind of available at a reasonable or a kind of a more discounted valuation with a long-term view of the intrinsic worth, by the way. So the focus is always on the margin of safety, by the way. It's very key for us. So entering with a kind of a cushion rather than kind of more optimism or not. So when you combine contrarian timing with the value discipline, the portfolio is designed to uncover the hidden opportunities that are kind of ignored by the momentum-driven investors, by the way. And that is a key edge in the Spear multi-asset approach, by the way. So as a PMS product, if you ask where we stand right now, we stand between the conservative to moderate range. So the return expectation, what you can expect from Spear would be from around 10 to 12%. It's something what the long-term Nifty 50 return has provided. Where in Spear, you can get that return with a kind of a less volatility in a more good risk-adjusted way, I would say. So now, so see, there are a lot of other mutual funds like multi-asset mutual funds, and how Spare is different from that. So if you see mutual funds, they have some kind of cap, which means like they need to have like minimum of 65% in equities, and they should have minimum something in gold, they should have minimum in silver and so. But when it comes to the Spear, we don't have any kind of cap. We can go from 0 to 100 in any asset class. If you feel that this particular asset class is more favorable, we can go in a kind of a single stage to do that. So that kind of opportunity is available in Spear, which you cannot see that in multi-asset mutual fund. So when you see the performance pressure, they are like more short-term performance pressure, but we are like more long-term active investing approach, as I stated earlier. So they are kind of more consensus based, but we are more contrarian investing. And the portfolio construction, as you know, you'll be provided based on the NAV. So NAV, in the simple terms, you'll be getting whatever they brought a kind of an earlier phases. The same thing will be provided to you. But when it comes to Spear, it's more customized through participation. When you come inside Spear today, based on today's opportunity, your portfolio will be constructed. When you come tomorrow, based on tomorrow's opportunity, your portfolio will be constructed. So in the long run, it will be aligned in the same manner. So it kind of when the exits happen, it impacts all investors, but in kind of any kind of exit like redemption and something, it only affect the individual investor who invested in Spear, by the way. When it comes to taxation, yes, the taxation is on redemption basis, but here the taxation is always in security level, because as per SEBI complaints, Spear as as a PMS, based on security level, the taxation plays the role. So yes, this is the team where the PMSs are managed. So as Spear is multi-asset product, same way Neo is also a multi-asset product where it's been designed specifically for the NRIs. Also, we have a FlexiCap product, Solitaire, and True Blue, which is a blue chip PMS fund, and we have a micro cap and a small PMS fund, that is Priti, by the way. And people here are our team members, by the way. So yes, this is our latest performance. Yes, thank you everyone. Thank you everyone for attending this webinar. We can see you in next webinar. Thank you guys. Thank you for your time.